Hello, everybody, and welcome to the Dorsey Wright Market Update call for Monday, September 21st, 2020. I'm Jay Gragnani, and here joining me this week is Steve Raymond. And this week, certainly coming in with a bang in the markets in terms of a spike in volatility, as this week also officially begins fall starting on Tuesday, officially September the 22nd. So as we're recording this, one day away from fall, and here in Richmond, Virginia this weekend, we certainly got some fall-like weather with highs in the 60s and lows actually getting down into the 40s. So seasonably chilly time here over the course of the past few days here in Richmond. Nonetheless, the month of September for the market is certainly a month that tends to be chilly in terms of just historical performance. As the month of September, the S&P 500, it's the worst month on record for the S&P 500. And with Monday's market action has seen, markets fall 2% plus. And in the case of the Dow, almost closing in on down 3% at one point as we're recording this, and that time being 1 Eastern time on Monday afternoon. Nonetheless, the volatility has certainly seen an uptick in the market, and what that has done is we've seen, and as we've talked about over the course of the past couple weeks, seen some deterioration from some shorter term indicators, but haven't really seen that deterioration fold over into longer term indicators. And that's, wanted to talk through today, provide a little bit of perspective in terms of what has happened over the course of the past couple of weeks. And even with today's action, as we look at a chart of the S&P 500, for starters, this is a 20-point chart of the S&P 500, which is a little bit longer term, a little bit slower chart than the default scale that's up there. It's about 10 points per box, but it helps us gain a little bit of perspective. And what we've seen now is coming off of the high that the market started off September. The first couple of trading days were positive, pushing the markets, the indexes to new all-time highs, up around 3580 for the S&P 500. And since then, what we've seen is the markets pull back. We've seen that what got to be a rather extreme overbought condition for the market has now was normal and is now moved to the oversold side of the ledger, giving a couple sell signals on the chart at 3320 initially, and then again at 3300. And so, Steve, as we look out at the markets today, in terms of where we might see some support come in as it relates to the charts and various support levels, initially we're not far away from that initial support at 3220, but there's some other key areas that we're watching too.
Yeah, in fact, JG, as the futures really held what I would call their first low bottom area all through the last several weeks, but it broke down about Friday at 1 o'clock and kind of sent a little bit of a shiver tone, over the market, in the close on Friday, and then Sunday night, ramped up to bring us where we are today. So I think we're still very close to the event horizon on this support that the S&P, did not hold. And that kind of opens up the door for various support levels that one could say. The 200-day moving average of the S&P, the main index is, for all practical purposes, at the 3,100 level. A lot of traders on the street are, talking, or, people might be talking about the fact that, that might be a good port where, maybe we'll see some buying before that happens, or see some buying coming in near that horizon. And of course, that 3,100 level, could come into play. And, as sometimes we, a level below that we could just open up and talk about, which is more of the 3,000 level, which there's a heck of a lot of support in that area as well. But I think it's just important to look at the close by support of the 200-day moving average at 3,100, and as JG, as you mentioned, the 3,240, which we're hanging on that support. The market's been banging on that 3,200 area today and holding it quite nicely. So, but those are good. It's good to know. Where these points of interest would be, and that's why you have the charts. So this is obviously an excellent week to monitor your charting, of your major indices, and of course of your important funds and your important ETFs that you would be using and trying to sense where those support areas would be, and then be able to take some action, whether there is an action called no action, but take action that you're aware of where the support levels are, so you can manage the position as we again go through September, which on record is one of the worst months historically of the year. So JG, yeah, I think that we've got several areas of support that are key areas of interest, and we'll have to ride through day by day and see how it plays out. But keep in mind that the moving averages are just below where we are, somewhere around 3 or 4% below where we are, and at least that's some comforting news. As since the event horizon back in March, the 200-day moving average became an important player in April, where most funds have been moving above the 200-day moving average back in April, and the market certainly has been promoting very positive moving averages since that time. I will point out the 1040 MU0 is an indicator that reads every mutual fund and ETF on its 50-day moving average above its 200-day moving average. And that indicator continues to uptick all through these down days. And so you can say in some sense these moving averages that, we just mentioned over the last few minutes are important levels, can act as good areas of support, and the market still is demonstrating, positive moving averages up to this point. So that's a little bit of good news. Back to you, JG.
Yeah, and as we are moving through, and obviously the markets, the index has got pretty well above any long-term moving averages. You're closing in here and very close to seeing a 10% pullback off of a recent high in the market. And, that is, that 10% number, that 10% pullback, that's the number where you hear a lot of buzz around, the quote unquote correction on a 10% number. But it's also something that historically is something that happens with regularity in the market. About on average, once a year, the market tends to pull back 10% at least once per year. And so that's something that is certainly normal. Obviously, we got much bigger pullback than that earlier in the year from the market indexes back in the March timeframe, February-March timeframe. But nonetheless, that 10% number, that is something that is close at hand on a number of different indexes. So what that will mean potentially is for those of you that utilize the cash bogey check triggers within the DALI system, those are close by. So that will be something to monitor very closely. Is it's about a 10% pullback that it takes to see some of those relative strength charts, like an equity index relative strength chart versus a money market proxy, to reverse down, and that reversal down would trigger that change. So that'll be something to watch for going forward. Again, for those that are utilizing that bogey check in that sense. But really, over the course of the past couple of weeks, what the volatility has done is, we've seen sell signals on the index charts like the S&P 500. We've also seen a number of sell signals come through on a number of individual charts that have caused bullish percents to reverse down. And, in the case of the New York Stock Exchange, bullish percent reversed down earlier this month, reversed down back on the 8th. And that reversal came at about, it hit 68. So it didn't get terribly super overbought, didn't get into the 70% level. And reverse down to quote unquote, put the defense back on the field with respect to the bullish percent. What was interesting about that is while the bullish percent, the New York Stock Exchange bullish percent was reversing down, it made a lower top relative to June. So the August rally that pushed, and then ultimately the first couple of days in September that pushed many of the equity indexes to new all-time highs, it was not carried by as many stocks participating as the New York Stock Exchange bullish percent was not able to exceed its previous high from back in June. It got all the way to 80% in June, just up to 68% in August. And so that, certainly something is suggestive that we might be seeing some evidence of either a narrowing in the market, the proverbial, the soldiers leaving the field while the generals continue to battle, meaning, i.e., the big cap stocks are the ones that were really carrying, a handful of stocks carrying the equity index its new all-time highs. The bullish percent charts, certainly turning negative. The OTC moving to bear confirmed status at 46%. Again, a couple of weeks ago too. It's certainly, as we look out at the landscape on a more shorter to intermediate term horizon, the bullish percent charts would certainly be something we'd look at today as being in the negative camp, as those indicators still being on defense. And as we're talking about this Monday, intraday readings have a number of new sell signals coming. The New York Stock Exchange bullish percent down almost another 7% today on Monday, and the bullish percent for the S&P 500 down almost 11%. So certainly the selling pressure is being picked up on the individual charts. A lot of charts moving to sell signals, and to Steve's comment earlier, just being sure that you're on top of charts, making sure you understand where support levels are, understand where different areas of support, whether it's trend line, whether it's otherwise, is just going to be continually important going forward, because one of the things that we are seeing unfold is some of these sell signals are leading towards some trend changes. Now, when we look at like the percent positive trend for the S&P 500 as an example, that chart will likely reverse down today, but it will do so. It'll still be up, above 50%. The PT/NYSE percent of stocks in the New York Stock Exchange that are in a positive trend, that indicator is weakening, but still above 50%. And those are just some things to watch. Those things historically in markets that those indicators are above 50% are typically good, healthy, broad equity markets. As those indicators move below 50, that's where we would see much more suggestive of much more narrowing market. But those will be something we'll watch for going forward. Because they're still, with these bullish percents turning negative, and we're still seeing positive pictures, as Steve mentioned, like the 1040 indicators, the PT indicators are still positive. The longer term relative strength pictures for equities continue to show that equities are in, say, the number one position within DALI, with fixed income right behind it. And that changed kind of in the month of August, with U.S. equities firmly moving back up into that number one position. So, there are some cross currents out there. By and large, when we look out at the market, the longer term relative strength trending pictures continue to be positive for the market, while we're seeing a bit of deterioration from some of the shorter to intermediate term indicators right now. And so with that said, just in terms of kind of some perspective and getting a little bit more granular on the asset class group score side of things, we see a very similar picture that we see in DALI right now, and that's still seeing very high scores from some of the equity leadership in the market.
Yes, in fact, the macro asset class view, which we're looking at now, still shows the S&P core type funds, at the leadership of this macro asset class kind of configuration. The readings have come down. The core was getting very hot up at the 96 and 97 level, and has moved back down. That by itself is not necessarily a bad thing. It tends to suggest there's other asset classes in play. And so right now it's a monitoring situation. We'd like to see the core, maintain above a 70% level. I tend not to like it when it's a 97% level, a little bit too hot, but, we're still holding some good footballs with the core at this level. The money market percentile rank, moved down into the kind of the 4 and 5 area, a little bit below that, and is starting to do an uptick here. So money market is now at the 7th percentile, meaning stronger than, 7% of the asset classes around the world. So a little bit of an uptick. What I tend to do is take notice when it hits that 15 level. When you're down at the super low level on money market, it hits the 15 or higher. You take a little more seriously that maybe something could be catalyzed as you get up into the above 15 level, and so we'll keep an eye on that, and certainly you can as well, to see if we strike any 15 percentile levels. And we don't know. And that's why we have to continue to monitor for that. But certainly September, with the tone being set really almost from the second or third day of September with some selling, it certainly is comforting that we have these indicators. You know, as JG mentioned, the different cash percentile ranks, this money market percentile rank, these indicators are meant to, give us a guide as to the turbulence level and the defensive tone level, of the market in general. So that's helpful to keep an eye on that. Other things to take note of, the non-U.S. is still showing some good scores, principally in emerging markets and so forth. And I haven't really seen that back off too much, holding still level. And so that's actually would be counted as a good sign, is that peripheral groups, many of which are holding in, I would say, bravely, against some market turbulence, where in some cases when we see market turbulence, we see groups that are on the peripheral, evaporate. And so we're not really seeing that. And of course, a good comment could be made for fixed income funds, which are still holding very stable. As you know, the fixed income funds you have in your portfolio all through the year, and quite frankly, for some of you, for many years, are trying to hold that NAV calm and stable, a little bit more flat. That's the purpose of the fixed income in this context. And I think that the fixed income is still, scoring, well strong enough to say, hey, these are very important groups in the asset allocation mix. So in some sense, the macro asset class picture that you're seeing now hasn't really changed that much, over the rolling month or two. But that's why we monitor it in case we do, see changes that would be considered either highly defensive, or changes that would be considered that the market has changed its preferences into the alignment of the asset classes. Either one of those two issues will be important to pick up on. So either you, as the advisor, can become more defensive, or you, as the advisor, can change up the allocation in the allocation mix to be in harmony with the market. So JG, I think that, with the short-term indicators, making some moves, now the advisor can handle and risk manage position by position, but also at the same time continue to look at the longer-term picture, to get guidance on that grander theme of that grander strategic allocation. Back to you.
Yeah, absolutely. And you can get even more granular, Steve, as we go through the market and look at, instead of looking at just that macro perspective on the asset class group score page, you have the ability to view all groups. And what this picture will show here is that there's still a number of healthy groups, that is, groups that are scoring 4 and better. There's over 30 of those groups right now that are scoring 4 and better, with obviously the S&P 500 index fund group being right there in the middle of all of the strength. But there's still a number of groups, to your point, to work with even more granularly, both on the U.S. equity side, some non-U.S. equity, and then some fixed income up in those groups as well.
Yeah, and I'd like to make a few nuanced points, if I might, where we still see a growth theme, where large growth, mid growth, and small growth are among that leading edge of the relative strength, top scores. I don't think that's changed. We're still looking at that to see if there are any changes. But take note that convertible bonds is now the number one scoring group on the system. Now, a couple things to say. We've mentioned convertible bonds here and there over the calls over the last several months. A point I'd like to make, I don't think I made before, which is, the convertible point I did make was convertible bonds are doing well. Tends to be a good economic, outlook that they are doing well. Tends to forecast good times ahead. Of course, the Fed stepped in. You see, and the Fed steps in, that's another force of power that provides liquidity and makes it, maybe some benefit to the convertible areas. And of course, as Jamie West might point out, one of our analysts, there are several other reasons why convertibles might be strong. But I'd like to make a final point, which is, convertibles are often the first to melt down when people are worried about the stock market. And that's obviously not the case here. Not only do we not see them melting down, but we actually see them holding in top score areas. where they have been, for several months, and continue to be. So I think that's an interesting sign that if this market was the type where everyone's trying to sell everything they can think of, I don't see that evidence as seen through some of these groups like convertible bonds still being a high scoring group. On that same tone, what you don't see in this view is, let's say, the microcaps, and you do see small growth, but the microcaps. And I will say that the microcaps are also a canary in the coal mine. Their average score is around 386, which is still among the highest scores I've seen this year. So they have not really backed off of that forward northward score progress. And usually, you do see a flighty nature to that group where it tends to evaporate and score rather quickly early on in some sort of defensive cycle. And we don't see that. So, the small cap and the micro cap, and I'll add another one, international small cap. International small caps actually are near, some of the best scores we've seen all in 2020. And they have a historic record of backing off greatly inside of a session of market turmoil, and I do not see them backing off. So if we're looking for, signs, whether they be small, no pun intended, from the small cap groups, tend to suggest, that the market is not as skittish as some might presume it is, as these groups tend to, when they hold up well, tends to show some bullishness out there amongst a fair amount of investors. And that there is some offense being played here, and people are holding on to those positions. So, again, I think JG mentioned that there's a fair amount of blue groups, meaning they score at 4 and higher. And, of course, there are other nuances, whereas, some groups that are holding in there quite well, which we typically may not see hold in well in market turbulence, and certainly not in September's, and they are. So if you're looking for some hopeful spots, that tend to talk about the market in a bigger fashion, then some of these groups I just mentioned holding in there well are a positive to consider. So you do have some things while the market's in a short-term defensive mode here with the bullish percents and other things possibly like the New York Stock Exchange high-low, showing some down moves here. You should take caution, as a serious thing, but at the same time, keep in mind that the total allocation, needs your help to address the fact of, what assets should we own in the allocation, what assets are showing great relative strength, and continue to think about that offensive football game and that opportunity that's there. I'll segue into this. The cash counters tell everyone that there's $4 trillion in cash on the sidelines in the market. Now, how they exactly add that up, let's say, is a little bit of this and a little bit of that, but that's an enormous amount of cash on the sidelines. And so one idea there would be is as we go through, some of these harder short-term issues, is remember there's a lot of gunpowder on the sidelines. And we want to respect that and be ready for that. And I'll also make a kind of a parallel point is I've had a lot of discussions with many of you, the advisors, and possibly some of them on this call. And, there's been, I would think, the idea that a lot of people are holding a lot more cash than they wanted to. And some of you as the advisor may have more cash than you had wanted to have back when the market was melting up. Well, you feel better now. Because now, hey, the market's had some good pullbacks. It may pull back more, as we pointed out, with the 200-day moving average still lower than we are. And you take a moment and say, hey, yeah, it's good I have some cash, and now I get another opportunity, to evaluate what the market's doing, another opportunity to inspect inventory, and keep in mind that you get a chance to move into great assets that have a lower price. And I think that's encouraging to say and encouraging to recognize is that we're still in this same game. The 2020 saga is by no means over, and I think that you still have opportunities in this market as we target from, let's say, now to the end of the year. And part of those targets, as JG just pointed out, some of these, great DALI equity signals, and as you can see here in the asset class group score, all group view, there's more blue groups than probably we can count. And so I still would like to say that there's opportunity. That's why we're looking all week and all next week and move through to September to take advantage of any opportunities. And of course, develop that buy list. And of course, as you play defense and do the right thing for your customer, you're also saying, hey, here's where the football looks like it's moving. Here's some great opportunities to take advantage of and feel good that you have some cash to do that with. Back to you, JG.
It's great, Steve-O. Just kind of in terms of wrapping up, we mentioned these things before, but I think it's worth reiterating as, we've seen, some of the shorter intermediate term stuff turn negative. So some things that we're watching for, and a lot of it really has to do with some of the trending indicators that we follow. Steve, you mentioned the 1040 indicators, 1040 MU0, which is measuring all mutual funds and equity charts, comparing their 50-day versus 200-day moving average. So right now, that number is at 80%, and as you alluded to, it has continually upticked, at least through Friday's market. But right now, 80% of that universe has a picture where their 50-day moving average is above their 200-day moving average. And that's, generally certainly a healthy sign. So we'll continue to see if that is able to uptick, through the coming days and the weeks, or if that begins to deteriorate a little bit. But that's certainly something that we'll monitor. Again, on the trending side, PT indicators, so PT NYSE, PT SPX, those are measuring, for instance, the percent of stocks in the S&P 500 that are trading above their bullish support line on their individual charts. Right now, that PT SPX chart is still in a column of X's, although I'll say as a result of Monday, will likely reverse down and will likely reverse down somewhere in the upper 60s to lower 70s area where once all the dust settles. So that indicator will reverse down. It will remain above 50% for the time being. So that 50% line on those PT indicators is typically a good line of demarcation to be aware of. The PT NYSE is a bit closer. That's down closer to through Friday was at about 55%. So that's a bit closer to dipping below 50%. So those will be some things that we're watching through the coming days and the coming weeks. Once all the dust settles and the data comes in tonight, certainly from Monday's action, we'll see how those look tonight and tomorrow morning. So with that said, as always, if there's any particular individual questions that you have, please reach out to us. The analyst team is here ready and willing to take calls, talk you through whether it's an individual stock, whether it's some of the indicators that we mentioned, whether it's some of the models that are on the platform that are designed to help guide through various market environments. Please do reach out to us. Let us know if you have any questions, comments, concerns, either phone or email address, both there on the bottom of the slide. So with that, as always, we appreciate you joining us this week. Appreciate you taking time out of your day to hear what we have to say and listen to some of the things that we're watching as we go through this market. So appreciate everybody's time and appreciate you being on and look forward to being on with you next week.